Most Inland Empire rental property investors approach their maintenance budget completely wrong, and it's costing them thousands every year. I've got a simple two-part plan to help you get those costs under control. Hi, I'm Brian Bean with Dream Big Property Management here in Riverside, California. This is part 3 of our 4-part Maintenance Mastery series. Today, we're talking about budgeting for repairs and maintenance on your rental home. How much should you plan for and set aside to handle costs to keep your property operating? If you're a rental property owner, you know maintenance is just part of the deal. Things break, they wear out, maybe they need to be updated because this is a house. But many owners, especially mom and pop investors, grossly underestimate the projected cost of maintenance and repairs. They buy a property thinking they're going to spend $500, maybe $1,000 a year on maintenance. Then they get hit with a $2,000 HVAC repair in month 3. I have seen this all too often, and it typically stems from one common problem. Inexperienced rental investors focus too much on just cash flow. Will the rent cover my monthly mortgage and scheduled expenses? That tunnel vision gets people in trouble really fast. One of our clients is dealing with this pain right now. They bought a house about a year ago or so. They hired us to manage it for them. The home was older, but it had been renovated and many of the systems were already replaced. But shortly after the new renters moved in, we got our first repair request for a dishwasher issue. The next month, there was a bug problem, but it was not caused by the residents. And then 2 months later, there was an issue with the irrigation system. The owner, who was understandably frustrated, had expected fewer repairs. Fast forward today, he's getting out. The property is for sale, even though it is a sound long-term investment. So today, we're going to pull back the curtain and talk about the real numbers based on industry standards and what we see in the course of managing single-family homes and small apartment buildings right here in the Inland Empire of Southern California. But first, let's talk about why this is so important. Successful rental property investing is not just about sitting back and collecting rent. It's not mailbox money. There are 2 major considerations to address. 1, when you have a rental property, you're running a business, and businesses have income and expenses, and you must plan for them in advance. And 2, no less importantly, you're partially responsible for somebody else's shelter. It may be your house, but it's their home. The stakes are high. You have to get this right because if you mess it up, it's going to be very expensive and it could involve some legal issues. So let's take these 2 considerations in order. First, we'll start with your business operations. Now, your rental property itself is a great metaphor. Before the walls went up, before the roof went on, before anybody moved in, the builders of your home poured the foundation. The stability and lifespan of that home rests on the foundation of that property. Your business foundation is your exit strategy, your financial wherewithal, and most importantly, your expectations. And it all starts with understanding how you earn with rental properties. We call it Profit Plus. It's the wealth building framework that explains the 5 profit centers that drive all rental properties. And those include monthly cash flow, value appreciation, monthly mortgage paydown, tax benefits, and lastly, hedge against inflation. Notice, cash flow, that's the money left over every month after the bills are paid, is only one of those profit centers. And so focusing only on one factor, it's kind of like building your new house on the sand. It's not stable and it's subject to the title changes. Consideration number 2, the people issue. Happy residents directly impact your profitability. Nothing keeps residents happier than quick professional responses to their maintenance issues. When things break, they must be fixed fast. Like it or not, people's expectations have changed. You can order something on Amazon in the morning, have it delivered before the nightly news airs. Your residents have those expectations. If you're not responsive to their repair requests, they're going to move out, and that vacancy will kill your profit. The point here is that if you do not budget properly, big repair costs could be delayed while you're sourcing funds, or you're looking for someone to do it cheaper, or you're just hand-wringing because you're worried. That will come back to haunt you with increased vacancy or unhappy, now uncooperative residents. Now, let's get into this. Here are the 3 rules to budget for maintenance and repairs. Number 1, the 1% rule. For every $100,000 your property is worth, budget $1,000 per year for maintenance. So a $400,000 Riverside rental, plan for $4,000 annually to cover routine maintenance and smaller repairs. Number 2, the age factor rule. The age of your property determines your prospective budget. Properties newer than 5 years old, expect 2% of the gross scheduled rent for repairs and maintenance. Properties 5 to 10 years old, budget 6% to 9% of rent. 11 to 20 years old, expect 10 to 12%. Properties 21 to 30 years old, 13 to 15% of rent. And anything greater than 30 years old, expect to pay 16% to 20% of your total annual rent. So, if you're collecting $2,800 a month on your 15-year-old property, your scheduled annual rent is somewhere in the neighborhood of $33,000. You should set aside $3,300 to $4,000 per year on repairs and maintenance. Some might think that sounds high, but it's actually pretty tame. Broken down, it's $280 to $340 per month. That's one service call. Lastly, rule number 3, the size rule. $2 per square foot for repairs and maintenance. In an 1,800 square foot home, in that case, would be about $3,600 a year. All 3 of these rules are for normal maintenance repairs. Examples might include like HVAC maintenance and service, plumbing issues like a leaky faucet, electrical problems like a bad outlet or a fixture replacement, appliance replacement and maintenance, routine general maintenance and minor repairs, and then landscaping maintenance. Here's what's not included. Major capital improvements such as a new roof or complete HVAC. Upgrades that add value such as adding a covered patio or renovating an outdated bathroom. Resident-caused damage. Although those costs typically are passed along to the resident, the owner is still out of pocket until they get reimbursed. And then regular monthly expenses such as utilities, insurance, taxes, or property management fees. These costs can vary significantly. They're based on the property age or if there's deferred maintenance. We recommend actually having a CapEx reserve. We'll talk about that a little bit more later in this video. Also, in the Inland Empire, which is a desert climate and is, in California, we have some special considerations that unfortunately increase maintenance costs. It's hot here. HVAC systems work harder and need more maintenance. Pool equipment, if applicable, run longer during the summer and need more frequent filter and equipment maintenance. Landscape irrigation runs longer and more often, and there's hard water prevalent. Intense sun exposure is hard on the exterior of a home, and the cost of living here makes labor and material costs higher than the national averages. So, resist the urge to underfund your maintenance and repair budget. Intentional investors do not just pick one of those rules. They look at all 3. They choose the highest number. Why? Because it's better to save and be prepared for a big ticket item than to under budget and stress about every phone call that comes in. Proper maintenance is not just an expense, it's an investment in your property. And the return is in the form of lower costs overall. Here's how properly budgeting impacts the 5 profit centers. Cash flow, preventive maintenance and attacking repairs early reduces your repair costs. It also reduces vacancy because happy residents stay put. Did you know that the average prep cost and loss of rent to make a home rent ready for a new resident is $5,000 to $10,000? That's best case scenario. Appreciation. Well-maintained properties appreciate faster than neglected ones. That means they can be sold or refinanced at a higher assessed value. Mortgage paydown. Consistent rental income from happy residents chips away every month at that property debt. Tax benefits. Maintenance and repair expenses typically are fully deductible. However, check with your tax advisor for your specific situation. And inflation. Over time, inflation eats away at the value of your dollar. So it takes more dollars to pay for the same repair. If you have fewer repairs because you properly maintain the property, you end up spending less in the long run. If you want more details on our Profit Plus program, that's hard to say, and the 5 profit centers, we'll include a link in the show notes to our previous video. Now, here's an example on how to set your repair budget on a rental home. The average entry-level home in Moreno Valley is worth about $525,000. It's 1,400 square feet. It's built in 2000 and it rents for $2,800. Using the 1% rule, you budget $5,250 annually. Using the age rule at 13 to 15% of rent, budget $4,300 to $5,000. Based on the square footage, you budget $2,800. Notice how the square footage rule trends low in this case? That data is good to know, but that method probably applies more accurately to like newer homes or properties that are over 2,500 square feet. Older, smaller properties simply cost more to maintain per square foot. So what's the smart move here? We would advise in that scenario that you plan for the higher number, $5,250, which is about $438 per month. In this scenario, the investor may budget that monthly amount, but that doesn't mean that they'll be paying that every month. Some months they might have 0 repairs. Another month, the water heater might die and cost $1,500 to replace. Now, there's a difference between budgeting for an expense and having the funds in reserve to cover those expenses. You don't want to be in a position where you budgeted for $400, but you had costs of $1,000. Without the money in the bank, that is where the last layer of your rental business foundation comes into play. The Ready Reserve strategy. With Ready Reserve, you have 3 bank accounts. The first is your operating account, or OPEX. This is where your monthly income and expenses flow into and out of. Number 2 is your repair reserve account, or RepX. This is where you keep the total amount of your annual repair budget. If you budgeted $5,250 for the year, that's how much you keep in this account, and you don't touch it for anything but repairs. And lastly is your capital improvement account, or CapEx. This is for big ticket items such as a new roof or HVAC replacement. This balance will vary based on the age and condition of your home. But in general, the older it is, the more you should keep. The more deferred maintenance you have, the bigger the reserve you should have. We recommend keeping at least 6 months of your total property expenses in this account. For example, if you've got a mortgage, insurance, taxes, and the budget expenses are $2,500 per month, you put $15,000 in this account and it sits there waiting for the worst case scenario, like a security blanket. As you use funds from your RepX and CapEx accounts, you then use your monthly repair budget to reimburse those balances over time. And each year you reassess the RepX and CapEx balances to adjust for budget or value changes. This is what separates accidental landlords from intentional investors. It's the difference between stress-free rental investment and owners who are forced to fire sell a property at a loss. It's smart, lucrative investing because it provides peace of mind and ensures your business can continue to operate during a crisis. It doesn't mean that you're not going to, that you won't have expenses. It just means you'll be prepared when those expenses hit, and they will hit. Rental property investment is the surefire way to build wealth, to go from financial zero to hero. And when you have realistic expectations about maintenance costs and proper reserves in place, you insulate yourself and your property from higher costs and lower profitability. It's the formula that equips you to scale your portfolio. Just lather, rinse, and repeat. Want help creating a customized maintenance budget using the Profit Plus and Ready Reserve strategies? Call me directly at 951-314-5402. I'm happy to share. You can also find valuable information on our website, dreambigpm.com. And if you found the information you heard here useful, please do us a favor, like and subscribe so we can help others just like you. Don't be accidental about your future, be intentional to your success.